Welcome for everyone. What we are now doing is build your financials in minutes, and we are very lucky today. We have Paul Smith with us, who was actually a commercial banker for 20 years. So we get to definitely take advantage of all of his wisdom. Paul, I'm going to throw this over to you and to learn a little bit of how to build our financials in minutes.
Okay, thank you, Carla. Good afternoon, everyone. The purpose of this webinar is really just to give you an understanding of how and why these reports are produced, and to give you an idea of the best way to produce them, and most importantly, to show you exactly where you should be starting. Your start part is very important. If you get that wrong, everything is compounded all the way down the line. Okay? Right. Most small businesses don't really enjoy preparing financial reports. They'd much rather get on with the day-to-day running of the business. But these reports are very important to your overall business plan, as they put down in numeric form exactly how you expect your business to perform. It's not only important for yourself, but also for any potential lender or grant provider. You do need to thoroughly understand how and why the figures have been calculated, so that you can respond quickly to any changes that have to be made in the future, and also so that you can comfortably answer any questions that finance providers may have for you. Putting my bank manager's hat on, I can tell you that lenders will be looking for your figures to be well thought out. They have to be realistic, they have to be achievable, and fully understood by yourself. Lenders will want to know how you would react to various adverse situations, what we call what-if scenarios, and we'll talk about this a little bit later on in the presentation. So, where do we start? A full set of financials should include what we have on the screen here. So we've got the breakdown of the startup funds, the income expense statement, cash flow, the balance sheet, and the break-even analysis. There is a complete example of a full set of financials towards the end of the presentation that's been filled out, so you can see exactly how that works. What I will be doing is going through these, not in too much detail, but just to give you an idea of what goes where and why. Points 2, 3, and 4 here ideally should cover a 3-year period, because that shows how you would expect the income to develop over 2 or 3 years. Make sure that you have considered all possibilities and always err on the side of caution. You don't want to be too optimistic, because if you don't hit those figures, then you have to adjust quite considerably, especially when you pick the phone up and talk to your bank manager and ask for a bit more money. A lender can lose money in a business if you have to do this too many times because the financials were too inaccurate. It shows that you haven't got a good understanding of the financial needs for the business. If you perform better than your projections, a lender will always look at additional funds more positively if you need more money to help you to develop the business. You do need to consider a lot of information, but it's very important that you invest enough time to get the starting point as accurate as possible. Any inaccuracies at the start will only be compounded as time goes by, and you will probably experience financial difficulties quite early on in your financial venture. So let's go through these individually. The first one is the breakdown of the startup funds. Don't underestimate how much you need to get your business up and running, but you do have to be realistic about what you actually need. I had a client recently that wanted to start a construction business. He had a couple of years' experience working with his uncle, but no real track record of his own, and only one contract on the books. Now, he said that he needed $250,000 for a new truck, various tools, trailers, excavator, etc. But he had no collateral available as security and only $25,000 in cash to contribute to the venture. His projected income showed that he could easily repay the loans that he needed and make a very good profit. But the projections were not realistic. They were over-optimistic, and there was no way that he could obtain the finance. We discussed a more realistic approach with pre-owned essential truck and equipment, and he was able to get the necessary finance to complete his first contract and so start a track record with his bank. So, what startup funds do you really need? Every business is different, but you have to make sure that you include everything that you can think of and build in a contingency. The funds can essentially be broken down into the two groups that we've got here. The fixed assets, those form part of your balance sheet, and then you have the operating capital, which forms part of your income and expense statement. These are just some examples. The working capital, which is the bottom item on the right, will be shown when you complete your cash flow forecast. Okay, moving on to the next statement, and this is the income expense statement. It's going to show how much profit, hopefully not a loss, that you are going to make. It's an analysis of your income and expenses on a monthly basis. But the most important thing here, as I said before, is to get your start point as accurate as you can. You will probably be incurring expenses before any meaningful income starts to come in, so you have to make sure that your figures start this, even if the first few months show that the business is losing money. Any lender or grant provider will expect that. It shows that you have a realistic approach to the start of your business. You record the sales and expenses in the month when they actually occur, and not necessarily when the money is paid out or taken in. For example, you may be able to buy your stock and inventory on 30-day terms. So you would record your purchases, which is the cost of sales, in, say, January, even though you don't pay for them until February. The same goes for sales if you offer 30-day or other terms. So where's the best place to start? Most people, when they start thinking about their business, will naturally look at how much money that they're going to be taking in. But when you start planning your business, the best place to start is on the expenses side. And the reason for that is that most of the expenses are fixed, regardless of how much money is coming in. Examples like rent, utilities, insurance, advertising, finance costs as well, like loan repayments, are also fixed. So as will be your initial salaries and wages. All right. I'll talk a little bit more about depreciation later on when we get on to the balance sheet. Once you've put down the expenses that you expect that you are going to make, then we look at the income side of it. So for a new business, income will usually take time to build up. So you have to make sure that you allow for this in your figures. Buying an existing business will usually mean that you have a known income stream from day one. Remember to take account of any seasonal factors, and if you have multiple products or services, it helps to list them separately or in groups. I've done this in the example for you later on so you can see how that works. The cost of sales will determine what your gross margin is, both as an actual amount and also as a percentage of the sales. This area can get a little bit technical and a bit complicated, but it does include any direct costs that are associated with getting the product or the service ready for resale. So for example, if you buy a large volume of model kits for sale in your shop, what you pay for these is the cost of the goods sold. If you employ someone to put the kits together and then sell the finished product, the labor cost would be included in the cost of sales. The bottom line, the net income, and that shows, again, as I said, hopefully how much profit you're going to be making month by month, and not a loss, but it can fluctuate. Remember that this will not usually show how much cash you will have available. The next report is the cash flow, and that shows how this works. So let's move on to the cash flow. Now this again is a basic structure. The example at the end has got far more detail into it. It doesn't show how much profit you're making, but it does show how much money you expect to have month on month. And I've seen many businesses over the years get into trouble because they do not give enough thought to this part of their plan. You record when the actual money comes in or goes out of the business. So in the previous example I mentioned, if you are offering 30 days terms on your sale, then what you expect to sell in January is recorded in January on your income expenditure statement, but with the cash flow, you don't record it until February, when the month that the actual money comes in. It's the same with any payments that are going out. You need to recall all cash movements, so your initial startup costs should also go in there. So it's the money that you'll be paying out for your fixed assets and any operating costs, and any money that is going to be coming in by way of loan, the money that you're contributing to the business. So it's a full record of everything that's basically going to go in and out of your bank account. And don't forget to record in there how much money that you're going to be paying for yourself. It's important to get this starting point as accurate as you can, as the bottom line will determine how much working capital or line of credit that you will need. Another point to remember, and this is very important, that the figures are always recorded on a monthly basis, but money flows in and out of the business at all times of the month, and this can dramatically affect the size of the line of credit that you need. A very quick example, if you receive $30,000 in the month and pay out $20,000, by the end of the month you will obviously have taken in an extra $10,000, and that will show in your bank account. But if you record the figures this way, the only problem now is that if the expenses go out at different times, so say of the $20,000 you paid $10,000 out at the very beginning of the month, and your income doesn't come in towards the end of the month, you're going to need $10,000 as a line of credit just to cover that for the first part of the month. Now, the best way to go around this then is to make sure that if you do have expenses going out, and don't forget most of your expenses are fixed, if they're going out at the beginning of the month, then the best thing to do is to record those amounts in the previous month. It shows a pessimistic picture on the cash flow, but it shows probably what will be a realistic one, and it will make sure that you don't run out of cash. Okay, the next slide that we have is the balance sheet. Now, in my opinion, this is the least important of all the 5 reports for small businesses. It can become far more important as the business expands, because a lot of people, when they're looking at figures, the lenders, grant providers and what have you, will look at various criteria and ratios that the balance sheet shows to make sure that this is a viable business to lend money to. All it is a snapshot of the business on one particular day, which is the year end. And it details exactly what the business has or what is due to come in and what it owes. The current assets come from the operational side of the business and detail items such as your bank account, the stock that you've got, any sales income that you have not yet received, and anything that you have paid out in advance for the following year. You might have paid insurance premiums in advance, that sort of thing. The fixed assets, now that basically will come from your startup funds report. So most of these items will have wear and tear, and they lose value over time, and that's where the depreciation comes in. Now, the depreciation values are approved percentages which can be written off each year, and the taxman is very kind here because that reduces your tax liability. The liabilities are what the business owes, and the difference between the two will be what the owner has in the business, and it will be any money that the owner has put into the business to start, the contribution, and any retained profit at the end of the year. Right, the 5th report, the break-even analysis. Now, that particular report is very important. It shows how much money you need to make to cover all your costs. All right, and it's important for you. It's very important for anyone lending any money, because what you need to do is look at the minimum that you need to achieve, and then look at what you are proposing to achieve. That's going to show the profit, and again, the numbers have to be realistic. It's basically an income and expense statement with the sales income adjusted to make sure that all the expenses are covered. Remember that most of the expenses are fixed, okay, and it is important that you compare this report to your income and expense report. The next slide is the example. Now, if you double click on this example, it's a spreadsheet, and you should be able to scroll through the various pages. So it shows all 5 reports. This is the income and expense report. We start off with the startup funds. This is a fictitious business that I've just put together just to give you an idea of what goes in where, and I've tried to cover as many of the points as I can. So the startup funds, you've got the breakdown there between the fixed assets, you've got the operating capital, and it shows how much you need. If you go down a little bit further than the total funds required on the startup page, this shows how you are going to achieve that funding. All right, so there's the money that you are going to be putting in, any loan, credit card, vehicle loans, anything like that. That is how the required funds are going to be achieved. The bottom line, which shows a 30,000 line of credit, we will see how that comes into effect when we look at the cash flow. The second report here is the income expense report. Now, this shows the amount of profit that you're going to make. And what I've done is I've broken down the sales income there into 4 different categories. So whatever the product or service is, small, medium, large, extra large. And again, it goes month by month. So this is going to change. I've tried to build in a bit of a seasonal nature there so you can see how that will change as the year goes by. And then you get to the end and you have the total column at the end. All right. The next part down is the cost of sales. That is a percentage basis. Now don't forget this is profit and loss, so it's the sales and purchases in the month that they occur. This isn't cash, so this is showing how the profit works. And you've got your gross margin there, so that's the gross profit that you're making when you get your product or service ready for the market, ready to sell. And then we have a breakdown of all the various expenses that we've got. So we've got the salaries, there's the money that you're going to be paying yourself, any wages and what have you. And then we come down to the fixed expenses, and I've listed quite a lot there. You might find that a lot of expenses you're not paying monthly, you're paying at a certain time of the year, so that's when it goes in. And some of these expenses, it could be a regular amount being paid every month, but every so often you need to pay a larger amount. So it's worthwhile to put that in separately so it's a very clear picture of what we've got. And then when we go down to the bottom, there's other expenses there. So depreciation goes in there, because as I say, that comes off your profit before you get your net profit, which you pay tax on. So that's nice of the tax man there. And then you've got any loan repayments or anything that goes in there. The tax line is basically calculated on the profit that you are making. And they go down to a little bit further than that. That shows the net income or loss every month, the profit or loss. And it shows the first couple of months you are not making a profit. And then the profit varies month by month depending on the seasonal nature of the business. And we get right to the end of that row, and that should show the final figure for the year. It shows that after you've been paying yourself, I think I put in $3,000 a month. There's also a $50,000 profit there, so that would appear in the balance sheet. The next sheet there is the cash flow forecast. Now this will be different. The same numbers have been used, but this shows when the cash is coming in and going out. And what it does show right at the start is that there's no income coming in initially in month 1, but you do have, there's a small amount of income, but not as much. But you do have the expenses there. So there's more expenses going out than there is money coming in. This is effectively the activity on your bank account. So this is how you would expect your account to go. So the bank certainly would look at this when you calculate how much you need. Now it does show that the most you're likely to need is 15,910, but I put in a working capital requirement of 30,000. It's no good asking for less than you might need. If you just asked for 16,000, say, to cover that, you could find yourself with problems straight away. Okay, so that is the cash flow forecast. That goes right through to the year, and it shows at the end of the year that you should have a sizable balance. Look at the bottom line there, 39,000 in credit, and that's after you've paid yourself 3,000 a month, so that's looking pretty good. The next sheet is the balance sheet, and the balance sheet basically takes into account you've got the money that is left. All these figures will come from the previous reports, and I'll mention now that what you will find is that there are a lot of spreadsheets available online which will automatically calculate figures month on month and go from one report to another one. So they do a lot of the work for you. So these figures here, they have a breakdown because you have what's called the current assets. Now, current assets are basically volatile assets. These are the assets that you need to operate the business. So any cash that you've got left, any money from sales that hasn't come in yet, the stock that you've got, anything that you've paid in advance for next year, those are all current assets. The fixed assets underneath, again, these come directly from the startup funds, the requirement that you've got. So this is what you paid for everything. And then there's the calculation of depreciation, which is different rates on each of the different ones. So we've got a total there, and you come up with a total assets for the company, the 197. On the liability side of the balance sheet, this is money that the business owes. So it's the money that is left outstanding on the loan account. Remember, this is just at one particular day. So at the year end, on that day, might be 31st of December, it shows exactly how much you owe on the credit card, on the loan, your vehicle loan, and that shows the money that is owed out. Now, if you go down a little bit further, again, the startup funds do show that the investment, this is the money that you put into the business, was $45,000. And it shows from the profit account that there was $50,000 retained profit after you took your money out. Now, if all that is added up, the liabilities and the assets, then remember that basically that the money you've put into the company, anything that's retained in, is a liability of the business. The business owes that money to you. That's why it shows on that side. And the two sides balance. So that is the balance sheet. And those are the no, there's one more, sorry. There's one more report to come. If you look at the bottom, I think we have the break-even analysis at the end of it. So again, this is taken straight from the income expense report. It shows the total sales for the year and the cost of sales. And again, we've got the gross margin there in two forms. We've got the numeric value, and then over to the right-hand side, we've got the percentage of sales. All right? So you are looking to achieve that, achieve a good rate there. If that starts dropping, you need to work out why. Then we've got a breakdown of the expenses. Okay, so we've got the fixed expenses, salaries and wages that will be going out, and it calculates how much money you need to cover that. If we go down a little bit further, it shows the break-even sale in dollars that you need to achieve. So you've got the $427,000. If you sell that, take your cost of sales off, take your fixed expenses off, you will effectively come down to zero. Right? That's the important thing because you can compare that to your actual income expenditure statement. Okay, right, moving on to the next slide. The what-if scenario. I haven't put many down here because there are just too few to mention. You constantly need to ask yourselves these. What do I do if? And you've got that competitor opens down the road. I mean, that can be good news because it can bring in more business overall for the product that you've got, or it might mean that you've got to look at your profit margins to make sure that you can maintain your sales. If supply goes bust, you've got to look somewhere else to get it. And then importantly, if your sales are substantially less than projected, how are you going to change the way that you operate the business? And that also goes for if they're substantially more, because you need to change the way that you're going to operate to make sure that you can take advantage of the extra sales that you are achieving. All right. So what-if scenarios are not always negative. They can be positive, but you need to make sure that you know in advance. And the way to do that is to constantly look at the figures that you've got. All right. So finally, you need to spend time on the financials, and it is very important to make sure that you get the start point as accurate as you possibly can. Because if that is out by 15%, then every figure is at least 15% out down the line. Okay, so concentrate on the start, make sure you get those right. Do keep actual records to compare with your projections. So if this shows that you're up 10% in one area, down 10% in another, and what have you, change your projections accordingly. See how that is going to affect the business 6 months, 9 months, 12 months down the line. All right? And if you think that you're going to need more money, mainly because you are, say, achieving more sales, but don't forget, profit and cash flow is different. So if you are selling more, but you've got to wait to get your money in, you might need more working capital. So keep your bank informed. Banks do like it when they get businesses contacting them and giving them good news and just letting them know we're doing this, send them some figures, this is how we're doing, just to let you know everything's going fine. Or even to say maybe in 6 months' time you might need a little bit more money, just wanted to give you the heads up. It doesn't come as a shock to the bank. Banks don't like shocks. They like to be kept informed and see the track record. So, producing financial reports, it might seem daunting, but they really aren't as difficult as they might seem at first glance. As I said before, there are a number of spreadsheets that are available online. You can download those, you can fill in the information, and the reports themselves are automatically populated. All I will say is the main tip, and I've said this a couple of times, make sure you spend enough time at the very start to make sure you get it right. If you don't, everything else is out and it just gets compounded. Just think of hanging wallpaper or laying the floor. If that first sheet of paper or that first line of flooring is out, by the time you've got everything else done for the rest of the year, it's way out. All right. So please spend the time doing that. Okay, that's basically it. I'd like to thank you all for attending the webinar. I hope you found it interesting, and I hope you found it informative. Thank you.